Having an overweight exposure to Asian equities was once considered a no-brainer, but these days Asian stocks are trading at significant premiums to Western markets. Joining us to weigh up the toss between Asian and Western equity markets is Louis-Vincent in our Melbourne studio. He's the CEO of financial services company Gav Kale and an expert on China. Look, thanks very much for your time, Louis-Vincent. Appreciate it. Now, if you're looking for value, is Asia the place to be, or should investors consider other developed markets?
Well, thanks a lot for having me, James. Well, as an Asian equity manager, I'd love to tell you that Asia is the place to be right now and forever. The reality, however, I think if you look at the past 3 months, there's been two very important changes for global markets. The first is that economic growth in the developed markets is turning out to be much stronger than people expected. And the second is that inflation in Asia is turning out to be stronger than expected. And as a result, I think you've seen all of a sudden shift in foreign flows from massively moving into Asia to massively moving out of Asia. The last quarter of last year saw record inflows from foreigners into Asian equity markets, and January saw record outflows from Asian equity markets. And it seems that until Asian inflation starts to roll over, this might be the new trend. So I think the reality is the next 6 months or so for our Asian equity markets may be more of a struggle as central banks tighten, as central banks get back on the curve, as foreign investors stay away and look for opportunities in their home markets. Asian equity markets may be facing a bit of a consolidation. However, once the inflation story rolls over, if it does roll over, then Asian equity markets will be set to start moving forward again.
Look, I suppose almost in simplistic terms, could you suggest that the Asian economy, the Asian markets have almost been victims of their success when we saw mature economies, the US, Europe and so forth, struggle with economic growth? We saw this fantastic sustained growth level in Asia, and of course, not surprisingly, investors looking for returns, the huge capital inflows into those markets, and that's really one of the main reasons we've seen this inflation.
I think that's definitely right. If you look at last year, the main driver of markets was economic growth. And the countries that delivered the best growth surprises, whether India, whether Indonesia, whether Thailand, were massively rewarded, and you saw a big re-rating. This year, the focus of the market has shifted. Nobody's worried about growth anymore, and you probably saw that the IMF a couple weeks ago released new growth forecasts that show that this will be the strongest year for growth since 2000. So all of a sudden investors don't have to worry about growth. They don't have to go chasing for growth. And instead what matters once again, probably to some extent, is valuations. And to the other extent is the sustainability of the policy mix. And in that regards, Asia's policy mix is a little bit behind the curve. And what you are seeing is Asian policymakers aggressively getting back on the curve, so raising reserve requirements, raising interest rates, but all that means a tighter liquidity environment and an environment which leads to far greater dispersion within the stock market and far greater dispersion between markets. And so what's been interesting in Asia is this year the driver is no longer growth. The driver of returns has been inflation. Markets with high inflation, like India, like Indonesia, have been penalized. Markets with no inflation, like Japan, like Korea, like Taiwan, have been rewarded.
You mentioned valuations before. What are we seeing in terms of valuations? I noticed, from what I understand, premiums actually at a higher level in terms of Asian market versus mature market, and that's not something that has happened for quite some time, if ever.
I think that's right. I've been in Asia for about 15 years, and I've seen Asian equity markets trade at a premium to Western markets 3 times. In '95, in 2007, and again in 2010. And the reason in 2010 was obvious enough. 2010 was the first ever cycle where growth was being led by China and not by the US. So this was a very important shift, and of course investors moved their portfolios accordingly. However, I think historically there's been reasons that explain why Asia's, and in fact emerging markets in general, trade at a discount. Really 2 reasons. The first, when you invest in emerging markets, you are investing in younger companies that have been typically listed 5, maybe 10 years. So you don't have as much of a track record to go on. More importantly, the companies tend to be a lot less institutionalized than Western companies. Things like independent boards, management training programs, well-audited accounts cannot always be taken for granted. So for all these reasons, emerging markets tend to trade at a discount. The other reason emerging markets tend to trade at a discount is, as Egypt has now reminded us, or Tunisia has now reminded us, when you invest in emerging markets, you're investing in countries with a far greater policy risk, where the political decisions are usually not the result of a long drawn-out consensus of checks and balances, but policy decisions can happen very quickly and surprisingly. As a result, I think historically they've traded at a discount because of this.
So do you think what we're seeing now, these valuations, are they warranted? Because if they are, you'd have to assume the investors who are sinking this money into these markets, or at least have been, are going to want to start seeing some return.
Well, I want to be clear here. Valuations are not yet stretched. What I would argue is actually valuations of most Asian equity markets seem about roughly fairly valued. On the flip side, maybe European equity markets are cheap, or US equity markets are cheap against their own history and against their earnings power that's now been confirmed by the return of economic growth. So it's not as if I think we should have big concerns about where the valuations are in absolute levels on Asia. Maybe in relative terms, the developed markets are marginally more attractive, and that may explain why this year in Asia, the more developed markets like Japan, like Korea, are the place where you want to be. But I do want to stress, valuations of Asian equity markets do reflect the underlying strong growth environment that we should continue to see over the next 5 years.
All right, Louis-Vincent, with your experience in Asian markets and what we've been talking about in terms of inflation and the paradigm sort of shift in terms of capital flows, where would you be putting your money?
Well, I think the trends are clearly delineating themselves so far in this year. And North Asia, the part of Asia that really doesn't have an inflation problem, is really outperforming. So you've got Japan outperforming, Korea, Taiwan. That's undeniably a good place to put money. But I think if you look at the underlying macro trends for Asia, there's a few key trends that are clearly appearing. The first, of course, is inflation. The second is the tightening by central banks. And the third, the big question you have to ask yourself, is as central banks start to tighten, and on the other hand, as growth in the Western world starts to accelerate, how much of a currency revaluation are we going to see in Asia? And for me, for the coming year, we should continue to see the trend that started in 2010 of very, very strong Asian currencies. Strong currencies against the US dollar, strong currencies against the euro. And so with that, if you think that the investment environment for the coming year is going to be one of flattening or even inverting yield curves and struck currencies for pretty much every Asian market, then I would say the last place you want to be is in an Asian index. Because in an Asian index, you're buying about a third of financials, 15% of real estate, 20% of exporters, all assets that tend to underperform when yield curves flatten and currencies go up. Instead, where you want to be is in the parts of the market that benefit from the currency revaluation. And that's the utilities, that's the consumer stocks, that's maybe the local telecom stocks. And these today are not a big part of the benchmark. That's why today you really don't want to be in Asian indices. I think ETFs, iShares and the like are going to have a tough time in Asia for the coming year. While managers that either focus on value stories or focus on growth stories, I think will tend to do much better.
All right, Louis-Vincent Cave, we do have to leave it there, but thanks very much for your time.